And let's take a look at what lenders and credit issuers are seeing here on commercial credit reports to better get an idea of why we're walking you through the steps that we're walking through in the finance suite. So what we're looking at here is a credit report where no credit is established. With Experian and Equifax, you can easily be given a failing business credit score, even if you have no accounts reporting on your commercial credit report. No good, no bad, nothing. So here's a perfect example of somebody that has a 28 score recommended for $1,000 in credit, and they have absolutely no accounts on their commercial credit report. This is it. You can see there's history, but I can't go any lower. So all these are zeros because this person has no credit established. So the first goal we need to do is add accounts in step 3, vendor accounts, to your credit report to establish a credit profile and score. Now, once we do that, this is the result. If you paid that bill as agreed, even one, your score shoots up to a 96, 100, depending on how you paid. And you can see the credit limit recommendation starts to rise too. So here's a better look at this. Here's somebody that had that 28, 29 score. They got one account on their business credit report and they shot up very, very quickly. And you can see here that here's that one account reporting. It's a packaging account. It's probably a Uline account. So here's the problem with commercial credit reports and the strength as well. The good part is we can get you a good score very fast because all you need, as you just saw, was even one account reporting. And if you have even one account reporting here as agreed, there's only one, then that one account, because your business credit scores are based on how you pay. So if you pay on time or early, you get a good score. So in this case, somebody got one account, paid it early, went from a very low score to a very high score with one account. Well, credit issuers and lenders know this. So because they know it's easy for you to get a good score with even one account being added, then what they typically base approvals on is how many accounts you have reporting. Let me show you an example. So here's another credit report where you can see the credit recommendation has really shot up. We went from somebody that had one account to $2,500, and that one account they were using less than $100, all the way up to now we're at almost $16,000 in recommended credit. So this client actually came in and has more than one account. Right now we've got about a handful of accounts, but we can see the recently high limit is still fairly small. So you don't have to spend a lot on these accounts to start seeing that recommended amount increase. But as you do start to spend more, the limits start to increase even more. So we went from having low score, no credit established, one account, boom, shot the score up, but one account wasn't enough to start getting approved for really recommended, high recommended amounts of credit. So then the next step that we take is jumping up to that credit report where we then start to see that the limits start to increase, the recommendation of credit increases, even because there's more accounts. This person's not using a bunch of this credit, less than $100 is all that's being used. But because more accounts are there, the amount of recommended credit is increasing substantially, and then boom, we start actually using the credit recommendation increases even more, and we can start to see that the limits on these accounts really start to climb. So now we're from that 100 being used, 400, 500, to now we're seeing the people use $2,000, $4,000, $10,000 on the actual accounts because there's more trade lines established and the limits start getting higher. The amount of credit you use does matter because then that also shows that they're using higher amounts of credit, and that recommendation for credit continues to climb, even with, in this case, the person has a charge-off account, which is resulting in a lower score. If you didn't have a charge-off, your recommendation for credit would be even higher. So now you see what lenders see, what credit issuers see, and hopefully the finance suite makes a little bit more sense. We want to take you from no credit report or low credit because you have no credits established to getting that first few accounts in step 3 to give you a high score. But lenders and credit issuers know that the score alone isn't what's needed. What they want to see is number of trade lines. They want to start to see you establish trade lines, and as you do this, then the amount of credit you recommended really shoots up. This is what starts setting the base basis for you to be able to get loans and credit lines, and also sets the basis for you to get higher limit revolving accounts so you can start to use the $4,000, the $10,000, the $2,000, all the way up to $20,000, $30,000, $40,000 limit business credit accounts. And again, also sets the foundation for you to start getting loans and credit lines. So make sure you work through the Finance Suite steps, because this is what your commercial credit report will look like as it continues to grow from no credit, low scores, or no credit profile existed, to start getting those first few accounts that you pay as agreed that give you a good score. Then we start getting you that depth of credit by adding more trade lines, which then is molding the credit profile that lenders and credit issuers want to see, to start getting you more high limit revolving credit cards and set the foundation for you to get credit lines and loans as well.